All right, call to order the special call meeting for the Siloam Springs Utility Commission, October 2nd, 2025.
Here. Can't hear you.
Oh, sorry. Can you hear me now? Okay. Commissioner Keck,
Here.
Commissioner Galici's here, Commissioner Carlos,
Here.
and then Commissioner Weil will not be here today. Let's go ahead and stand for the Pledge of Allegiance. Don't do minutes on this one, right? Okay, just make sure. All right, well, I guess we are ready for the presentation.
This evening, we have a representative from 1898 and Company, David Nauman, here to present to us the first findings for the utility rate study. Thank you, David.
Good evening, Commissioners. My name is Dave Nauman, and yes, I'm with 1898 & Co. It's a part of Burns & McDonnell. And I wanted to introduce a few folks that I've got on my laptop connected to us via Teams tonight. I'm the project manager responsible for the overall conduct of the study. My background is in water and sewer utilities, but we have a water and sewer lead, Alex Craven, who's on the line with us. Adam Young is our electric expert, and Allison Acarius is here for solid waste. So to the extent you have any questions that we need deeper expertise, we have them available. In terms of agenda, I think it's helpful when we start talking about utility rates to give you some context around what we see happening to utility costs nationwide. And then we'll do some regional comparisons of your existing rates so you have an idea of how the residential bill compares relative to your peers. And then we'll shift into findings, preliminary findings from the study. We'll talk about the project approach and kind of where we're at and where we're headed, and interested in your feedback on where we're at. So in terms of background information, I think it's helpful to look at what national household water, sewer, trash costs, and energy costs have gone relative to what we think about as general inflation, which is CPI. And this chart graphs the cumulative change in these indices. They're provided by the Bureau of Labor Statistics. Both that water, sewer, trash index and the energy index are part of household CPI. And if you look at the annual rate of change from this information, what we see is that water and sewer and trash are increasing at about 4.5% a year. Energy is at about 3% a year. And CPI over that same period has been about 2.5%. We know that there are some drivers that make costs for utilities unique. It's different than your household expenses. It can be things like regulatory compliance, inflation on the types of costs that your utilities incur, particularly chemicals, can really be different. So there's a lot of reasons why we see household utility costs rising faster than inflation. I might point out too, CPI in the last 3 to 4 years has been rising at about 5% a year on average. It peaked in 2022, but you can see the rise in the bottom line where CPI really accelerated. The utility indices didn't respond quite as hard. So we'll shift into talking about how your regional bill compares. So this first one is water. It's for an average residential user, 6,000 gallons a month. And what we have across the bars are the different bills for that level of use for some of your regional utility peers, and then compare that to Siloam Springs, which is in the green, and the average across the survey population. And what you'll see in the case of water is that you're relatively below average, right? You're about in the middle of the population, but this average is really skewed by the 4 utilities to the far right. In sewer, it's a similar outcome, a little more uniformity in the level of bills that we're seeing. You've got 3 that are pretty low and 3 that are pretty high, and everyone else is kind of clustered in the middle. I would say your current sewer rate for your average resident is about average for this sort of comparison. On solid waste, again, there's a kind of a cluster in the middle of this graph, and for that 96-gallon level of service for a residential customer, you're just a little above the average for this survey. And the last one, and this one's formatted just a little bit differently, but from an energy standpoint, this is the average price per kilowatt hour that a resident pays, and you're right at average. But again, there's a lot of similarity, I think, across most of the regional peers that were drawn here. And so the things to note just from that information are that household costs are rising faster, particularly in the last 3 to 4 years. That residential cost in Siloam Springs for most of your utilities is either a little below average to about average, and your rates haven't changed. The last adjustment was made in 2021. So that's the background. What we'll get into now is preliminary financial plans. And what this graphic will show you is that the 3-step process that we follow aligns with industry guidelines and standards, and it really starts with financial planning. That's that first step. That tells you how sufficient your current revenues are in meeting future costs and complying with your financial policies. And to the extent that they aren't sufficient, it gives us an indication of what the system-wide level of increase would need to be in order to address that funding difference. We get into things like how big is your capital plan, how are you going to fund your capital plan, how's your O&M inflating and your revenue growing. Those are all components of that financial planning exercise, and we'll talk about some preliminary findings from that tonight. That's really the place that we're at currently in the study. The next 2 phases relate to how you price your service. So we can look at your costs and assign them to classes based on how they use your system, so a residential versus a commercial connection. That gives us some indication of how equity looks like from a rate standpoint, and then we use that information to help design rates that recover the revenues from the financial plan and are fair. So those next 2 steps will come following the completion of the financial planning piece, and that's what we'll get into next. Our analysis would indicate that all 4 of your utilities really are weakening financially. I think the strain of inflation and the need for capital investment and the lack of change in revenues and rates over the last 4 years is catching up. And so we see funding gaps, and we'll talk about that here by utility in the following slides. But one indicator has been there hasn't been enough money in utility reserves to cover the need for inventories, especially for your electric utility. And so your reserves that are currently in place aren't sufficient to pay back the general fund's coverage of those costs. There's about $3 million, $2.9 million left to repay after your reserves. And so that's a part of the plan. What that means is you're not starting out this plan with much revenue or cash in the bank, reserves in the bank, and we have an obligation to pay back the general fund for some of the borrowing that's happened over the last few years. You have capital needs for all 4 utilities. Those capital needs are driven by either regulatory issues or the need to accommodate capacity and growth, or just to sustain existing infrastructure. Those aren't unique. Most clients we work with have the same sorts of drivers in their capital needs. But at a point where you're relatively weak financially, you also are facing investment that needs to occur. And so there's a combination of approaches to funding the future need. We'll propose some revenue increases, which will mean rates will need to rise. There is some anticipated sales tax funding to help offset the cost of capital investments. So that wouldn't be coming from utility rates, would be coming from sales tax. And then there is some additional borrowing primarily for the wastewater utility from the general fund to help complete the Headworks project, which is a regulatory compliance issue. Even with the levers that we're pulling to prepare these plans, your reserves are still going to be relatively weak 5 years from now. We're not really gaining a lot of ground with respect to the reserve position. And so that's just something to keep in mind. This next slide goes through some of the key assumptions that are involved. And the first one is we know your systems are growing. We've assumed in the forecast that you've got about a 3% increase. We've had some talk on the team about whether maybe that ought to be 4%. So I would characterize the plans that we're going to show you as preliminary. I think they're indicative of where we're heading, but we're going to continue refining them. And we'll also, of course, be interested in your feedback. So we have some growth. We're anticipating operating inflation on your existing O&M costs to be in the range of 3 to 6%. It averages out to be about 4%. Again, a little elevated relative to CPI, but consistent with what we see with a lot of our clients. Your utilities transfer revenue, or percentage of the revenue to the general fund. Those percentages don't change. They're a part of the financial forecast, and we're anticipating them as part of the cash flow. You can see the level of capital improvements in the middle of that chart. So for the electric utility, it's about $29 million in investment from 2025 through 2030. Water over the same period is about $11 million. Wastewater is high at 44.5, and then solid waste is $725,000. The primary driver on the wastewater side, on the utility funded aspect, is your headworks facility, which is about $7 million of that. But there's a lot of need. And you can see in that capital improvements box, the majority of the funding comes from utility revenues, with the exception of the wastewater utility, which is anticipated to benefit from sales tax. General fund borrowing doesn't recur for the electric utility or the water utility. For wastewater, the primary loan there is associated with the headworks facility that'll be paid back over 15 years. And solid waste also has some small loans. That's another thing we've been evaluating even as late as today as to whether or not that ought to change. Beginning operating balance is, again, 0 for your 3 of your utilities, and electric needs to repay that $2.9 million balance over the next 5 years. And I mentioned that at the end of the plans, we're not really complying with the 90-day reserve target for your reserve balance. We never quite get there for wastewater and solid waste, and for the electric and water, we get there intermittently, but not consistently. So I know that's a lot of information. What we're going to look at now are 4 graphs that will show you the cash obligations of the utility in the bars, and compare that to revenue under existing rates and revenue with proposed increases. And so we'll talk about electric first. It's your largest utility from a revenue standpoint. The components of the bars include purchase power, which is gray. The O&M, the operation and maintenance expense, is in blue. The transfers back to the city are in red, and then that cash-funded capital is in yellow. There's a small amount of debt outstanding that really gets lost in the scale of these bars, but it's at the very top. The lines compare revenue under existing rates. So the black line is your projection of revenues. That upward trend that you see in that line reflects that 3% growth that I mentioned on the assumptions. And in order to bring those revenues into alignment with the annual cash expenditures that are projected, it would require about a 4% per year increase in the system-wide revenue stream. So that's electric. For water, again, similar format. There's no purchase power, obviously, in water, but O&M is in blue, the transfers are in red, the cash-funded capital is in yellow, and you can see the trend upward in existing revenues, and the proposed adjustments to satisfy the gap we see on the water utility are also 4% per year to meet the future needs. Sewer utility has a little more challenge, and then solid waste, the scenario we'll show you here has more of a funding gap to address. On the sewer utility, similar to water, you've got an operation and maintenance component, you've got the transfer component, you've got the cash-funded capital, and then most of the green bar that you see there is the payback for the headworks facility. And again, a 4% per year increase would solve that gap over time. I might note for sewer, you'll notice the height of the bar in 2025 is above the line, that black line. So just from the outset, we see some weakness in the overall cash flow. Water and electric were a little healthier in that respect, but they can't sustain the position without revenue increases. And then I want to couch what we're seeing on the solid waste piece, because we've been doing a lot of iterating, even as I was en route here today, around how we might optimize or improve this plan. Similar format, O&M is in blue, the transfers are in red, the yellow is cash-funded capital, relatively low capital needs in your solid waste utility. But we have a fair amount of debt, and it's primarily because at the front end of the program, you can see the revenues don't compare very well to the height of the bars. And so we're borrowing in order to make it work for those first 2 or 3 years, and then it improves over time. We've had a lot of talk on the way down here about how we might approach this differently. We have a scenario that would have a uniform 8.5% per year impact to revenues rather than the front-loaded program that you see here. So we'll continue iterating on that, but this one would show a pretty substantial need for a change with the scenario we've got in front of you. The last piece of information that I'll give you, and then we'll talk about next steps, and I'd be happy to address any questions you may have. So at this stage of the study, because we have a plan for each utility that has system-wide increases, we can project what the potential impact would be on residential bills. So we come back to those averages that we were using in the regional comparisons at the start of the presentation, and we just extend them based on the percent increases. So for water, sewer, electric, it'll be 4% per year increases, and then solid waste is following a little different path here. The caveat on this is that how you actually price your service to accomplish the necessary revenues could be a little different than those system-wide increases. So maybe commercial would pay a little more than resident, and so that wouldn't be necessarily the same impact on everybody. We're not quite there yet in the study, but this will give you some context. So for an overall bill for all 4 services in 2025, that averages out to be about $202 per month. In 2026, it increases about $13, assuming across-the-board increases in the plans that I just showed you. And that's about a 6% increase in the total bill. Obviously more for solid waste, and then we had 4% for the other utilities. If I look all the way out to 2030, that bill goes from $202 today to about $259. That's on average about a 5% increase. So that it's higher earlier because the solid waste plan had higher increases initially, and then they came down over time. It averages out about 5%. It's not terribly different from what we see happening nationwide, but there is a front-loaded aspect to that solid waste scenario. The increases that we've talked about are really driven by the need to invest in capital and to improve your overall financial sustainability for each of the 4 utilities. So last slide. We'll be back next Tuesday, I believe, to present the same information to your board of directors. I think that solid waste scenario may be a little different when we get there. We'll continue refining that. But we'll have a similar presentation, similar conversation. Based on the feedback that we receive from you and from the board, we'll make refinements to those financial plans, and then we'll move into the subsequent phases of the study to actually price your service. So the development of proposed rates would follow for each of those utilities, and then we'd come back to you and show you those final financial plans and then the proposed rates that are associated with it. At that point, we can give you a very clear indication of what the impact would be to that average residential bill rather than the estimates that I've prepared for you today. So that concludes the material that I was hoping to get through. I would be happy to address any questions you may have or call on my counterparts to assist.
So based on, if we go back to slide 6, where we are at currently on the water bill comparison, where would the projected increase put us? What would that put us closer to? What city?
That's a great question. So let me go back to the last slide. And again, we're working with estimates here on the bill impact. So water would go up $2, 30, I'm rounding here, 37, almost 38 to 39 and change. So if I come back to water, it's
Would
really
still
not
be
going to change
below
your position.
average?
Yeah, clearly below average. I would guess, maybe relative to Springdale or maybe Batesville.
I guess one of my questions that I have is just if you, after analyzing all of this data and looking at everything, we have an estimated population increase this year of around 20,550 people. How are we in the spot that we're in financially? How did we get there? Because these seem like tremendous increases for the citizens to have to absorb. I mean, whenever you're looking at a solid waste increase of potentially, what was it, 25%?
Like 20 initially, yes.
Yes.
Or 8.5 on the average scenario that we were working on today.
That's still, though, whenever you think about average salary increases, I mean, I just want to know, how did we get to where we're at?
That's a good question. And so part of that answer sits in this sort of data, which is your rates, in a period of very high inflation, your rates haven't changed in 4 years. That's part of the equation. Part of the equation is we know that household utility costs are rising faster than other household costs in general. And that's driven by regulatory drivers, right? The need to reinvest in your system to comply with administrative orders, for instance, on the wastewater system, and aging infrastructure. The reality is your systems need new spending to keep the assets in good operating condition. So it's a combination of those things.
How has growth played into that? Because I know that we've had exponential growth year over year. So how has that, can you tell us how that's contributed to get us to where we're at? Or if that growth could provide potential cost-saving measures that could be passed down to the citizens? You know what I mean? Like with more people moving into town, that's more bills. That would seem like more income moving into the area. So could that lower the potential increase year over year?
It could. So growth does two things. In communities that have growth, it's an enviable position to be in. We work with a lot of cities where the population's actually declining, and a lot of your utility costs are fixed. So as population declines, that puts more pressure on rates for the exact same service. It's the opposite in your situations. We're projecting 3% a year growth. I mentioned earlier we talked about maybe that ought to be 4%. Every % increase in growth will give you a % relief off your increase in your bills. So I'll put it this way. If we think that 3% is a conservative measure and you actually grow more than that, you will be financially stronger than what we're projecting. And that's, all things considered, a pretty good position to be in. But growth will help you offset the fixed cost recovery that is inherent in every one of your systems. You get more leverage out of your assets when you have more customers using them, until you get to the point where you have to generate or accommodate new capacity. But it's cheapest for your ratepayers the more people you're serving, generally.
So how are you passing this on to the customers? Like, is it a percentage of their bill that it's going to raise, or is it a number, or is it how does that work? And is it different for commercial versus residential? Or?
It could very well be. So once we are at a position with the financial plan that we're all in consensus, and let's move forward with those projections, we'll go through that analysis that says, all right, who really should be paying what based on how they're using your system. And so you could have differences in commercial versus residential. I know on the solid waste side, that's one of the feedback items that our team has observed, is they think there's probably more increase coming on the commercial side than residential. So I do think it'll be a little different depending on the type of user you are, rather than the average change that I've shown in the bill projection at the last slide. But that is to come. So the first step for us is what's our funding target, right? How much do we need to change revenues by, and then we'll price the service to get there.
We're thinking it's going to increase, but we don't really know how much or how.
I would,
Specifically, at this point, we don't have that number specifically.
we aren't final by any means on the pricing, but some utilities will increase rates across the board, meaning every price and their user charge, the fixed fee and the volumetric fees all go up at the system-wide increase of 4%, for instance. So if your cost of service indicates that that's a reasonable approach, that's what we would do. But if there are some indications from that analysis that says one should be going up more than another, we can act on that.
And I know that you mentioned sales tax could potentially offset this. Is this the idea that the quality of life that's currently under the sales tax would be asked to be renewed, except go towards utilities instead of quality of life? Is that what the thought is?
That was not an assumption that we made at this point.
Okay.
At this point, we just looked at the major projects that would need to be funded out of our 5/8 mostly. There is some 3/8, but it's not a significant amount.
So this would be potentially a new sales tax that would be proposed for
Basically, what
citizens?
we would be proposing is that when the water treatment plant is paid off, that we divert that tax to take care of our wastewater treatment plant and collection system.
Which sounds like a great idea. Yeah. So not really a new additional one, just,
It's not a new additional one, and also, this is, when you're looking at the proposed increases for the rates when we get there, that assumes that we are able to do that. These rates don't include anything that we could potentially divert with sales tax. Existing sales tax.
So you're saying all of these rates, our rates since 2021 haven't changed on any of these?
Right.
It's been the same,
That was the last year of change.
the last time it changed. So with this, you're saying now it could potentially increase each year?
Right.
Okay. But we weren't doing that in the past for,
Not in the last 4 years.
Right.
No. I think prior to that, Christina, keep me honest, I think you had a CPI-based adjustment.
Prior to that, we had a CPI-based adjustment. So whatever the CPI was, we would increase our bill. So at the time, most of that time, it was only like 1 or 2%. CPI was really low at that time.
Yeah.
So it wasn't a significant change from year to year. But when we did our last rate study, there was a change made to stop the CPI and then stop the rate increases without, I think they gave us the option of being able to bring something back, but
so that's something possible. I know this says through 2030. So if at some point you sort of caught up or you CPI, whatever, you could maybe not increase it every year or?
Possibly. Honestly, there's different communities prefer different approaches, and some like more of a slow and steady annual change rather than
All at
a
once. This
wait
seems like a
and
big
then
jump at
kind
once.
of rip the Band-Aid off. And that tends to be a little more disruptive to budgets sometimes. But either way, when we look at the long-term impact and costs for utilities, it's rising annually, whether you're adjusting your rates or not. So there's an element of having to keep up with your cost structure that drives this.
So is the increase going to be looked at every year? Okay, so say it's 4% this year, possibly you have a good year, a lot of growth, it could be 2% or it could be higher, or vice versa, you know?
Adjust
So-
or fluctuate maybe?
Right.
Or?
there really isn't anybody on staff that can do that assessment. So we would have to either pay for it to be done every year, or what is more likely to happen is if we get ahead of where we need to be, then at the next rate study, our rates would not go up. Does that make sense?
Okay, yeah.
The other bit of context on that too, is that these plans don't put you in a position where you're flush with cash in 2030 either. And so if you have some better years than we're anticipating, it will make you more resilient financially, which is also a good thing. That the more resilient you are and the better reserved you are, the less susceptible you are to cost change. So that, it will help you if things turn out better than we're projecting, and you'll come out stronger on the end.
So for clarification, just so you're aware, there are no reserves in utilities. We still meet our citywide 90-day reserves, all out of general funds.
Right. I saw that negative. Well, the hardest part, I think, is just to tell the public, it's such a big jump at one time, but it hasn't increased in so long, so have to be able to explain that well to the public to say this is why. They don't really care about how much funding we have in 2030. You know, they care about what's coming out of their pocket next month.
Understood.
So,
Or how flush our fund gets, because I don't think that really most of our citizens feel like this should be a money-making situation.
Right.
You know what I mean? So I don't think that that is something that the citizens really want the city to make a bunch of money off of electric and solid waste.
I would say, so most utilities are operated as an enterprise, which means the dollars that are generated by the charges that are assessed stay within the utility enterprise. So any dollar that you make that may be $1 more than you needed is still available for assisting in the investment in your system. You're not doing everything that you could be doing in investment here. I think your staff has tried to be pretty measured about what can we really afford to get done in improving your systems. But you've got aging infrastructure that needs attention, and so that will help. Or, as Christina said, you could make the decision in the next round of increases to use those reserves to help offset the cost at that time. But we're not projecting a money-making enterprise here. It is break even in the way we forecasted it. Yes?
Can you hear me?
Yeah.
Yeah, I don't know if they can, but yeah, on the electric side, there is no money being made. In fact, we're trying to dig out of a hole of 2.9 million and barely cover our costs.
So in other words, what Adam is saying is, as we look out over those 5 years, you are kind of at a break-even position on your electric utility.
But there's 2.9 million back.
Right.
So
That-
To the general fund.
Right, to the general fund, correct.
What, if any, does GRDA contribute to the, I guess, maintenance of the infrastructure?
There's,
I said, what, if any, does GRDA contribute to the maintenance of the infrastructure?
As far as maintenance, our infrastructure, they just help us when we have major storms, that mutual aid agreement we have with them. But as far as the maintenance, they don't help us on a day-to-day basis. They just
Oh.
keep their interconnects that serve us maintained, so we have reliable power.
Okay, so like for growth and aging infrastructure, they don't really contribute to that?
Not in our distribution system, they don't. You might be interested, we used to be served by SWEPCO. Back in '88, we changed over, and I went to Bentonville, who's served by SWEPCO, and they gave me their rates for the last 14 years. And by going with GRDA, we've saved right at $68 million. So having them as our supplier, we've had a significant savings.
This just goes to the board if Tuesday and you discuss with them of,
We'll have a similar conversation then. I think we will have some revisions to that solid waste plan so that it's a little more level and not so heavily front-loaded like you're seeing. But yeah, similar content, similar conversation.
I'll go ahead and make a motion to adjourn the meeting.
Well, thank you so much, first of all, for answering all of our questions.
My pleasure.
Yeah.
Yes, thank you. It
Thank you.
was very informative.
Good.
Second, I'll second.
All right, meeting adjourned. Thank you so much.